Hi, I'm Jim Weisel, and this is going to be a brief introduction to Financial Accounting and Reporting 2. What I want to do in this video is just discuss very briefly the strategy that we're going to be taking in the course for the semester. So let's get started. My focus here is on something called MRDA. And MRDA is just an acronym for Measurement, Recognition, Disclosure, and Analysis. That's the strategy that we're going to apply to virtually everything that we do in financial accounting and reporting this semester. So measurement has to do with the valuation of financial events. For some of the financial transactions that we'll be examining during the term, valuation will be a very simple process. So for example, we sell some goods on account for $5 million. There's really not much to talk about in terms of the valuation of the event. We know how much revenue is being generated, and we know that the sales transaction is going to be based on an open account, and so it's a relatively straightforward process to determine the value of the transaction. It's just simply the $5 million. For other financial events, measurement or valuation is going to be significantly more complex. For example, when we get into leases, and lease transactions can be very complex, and we may have to determine the present value of future cash outflows, and do those present values meet certain criteria, and that will alter how we will go about valuing the underlying transaction. So measurement is the first step, and in some cases it's a relatively straightforward, very simple process. In other situations it's going to be significantly more complex. So we just need to be aware that measurement is going to be our first place to start, and in some situations, again, it's a relatively straightforward process. In others, a little bit more complex. Once we have the valuation of a transaction or a financial event, then we can move on to the recognition. Recognition is just the recording of the journal entries. We're going to use summary journal entries, very similar to what you did in FAR 1. My emphasis is really not entirely on journal entries. Realistically, the journal entries is not what's important. What's important is how do financial events affect the financial statements of a company. So the journal entries are only a means to that understanding of how financial events affect the financial position and financial performance of an organization. So the first step is measurement. Do we have a valuation for the transaction? Second, we will be discussing and working our way through the journal entries because the journal entries are a good way of gaining an insight into what happens on the financial statements themselves. The third step in the process is disclosure. So once we have measured a financial transaction or event and we have recorded that transaction, then we can talk about the disclosure. How is the effect of that financial event going to be communicated to the users of the financial statements? And disclosure includes both the financial statements. In other words, did the transaction have an impact on, say, the balance sheet or the income statement? Does it affect current liabilities, long-term liabilities, shareholders' equity? That sort of thing. That's the body of the financial statements. And we'll take a look at all four of the statements that we normally deal with: income statement, balance sheet, statement of cash flow, statement of changes in shareholders' equity. The focus in the course is primarily on how these financial events affect the balance sheet, but we will be discussing the disclosure impact on the other financial statements as well. However, disclosure is more than just the financial statements. There's also the footnotes. The footnotes to the financial statements is an integral part of the financial disclosure of the effects of financial events and transactions. So a lot of times people tend to overlook, or we kind of brush over the footnotes, but it is an absolutely critical and crucial part of describing how financial events affect the financial position and financial performance of an organization. So the footnotes are going to be very important as well, and we'll be discussing those as needed. The last step in our process or our strategy for the FAR2 class, the A, is going to be analysis. And analysis has to do with understanding the impact on the financial position and performance of the organization. So we're interested in not just getting to the point of being able to record transactions and understand the effect, or understand how and where to disclose those effects on the financial statements, but we're going to have to understand the analysis of the financial statements as well. So for example, when we sell goods on open account, that $5 million sales transaction, that's going to have an effect on the income statement, obviously increase sales. It will also have an effect on the balance sheet through accounts receivable. What does that do to the, say, debt-to-asset ratio of the company? Does that significantly alter, or in what way would that transaction alter the financial position of the company? And a lot of times the financial position is measured by way of financial ratios or trend analysis and that sort of thing. So that's the strategy that we're going to be employing in the FAR2 class this semester. Measurement, recognition, disclosure, and analysis. And we're going to be repeating that process for each chapter or each topic. We will be starting with Chapter 13, which is current liabilities. To be realistic, there's only a few sort of issues with respect to measurement of current liabilities. Most of the time, current liabilities are relatively straightforward in terms of measurement, although there are some challenges with some of the other liabilities that are discussed in the chapter. For example, contingent liabilities. That can present a little bit of a valuation issue. Recognition, again, has to do with the journal entries. And then we'll move on to disclosure. How do these events appear or show up in the financial statements and the footnotes? And then finally, the analysis, which is gaining an understanding of the impact on the financial position and financial performance of the organization. So that's a very quick sort of overview of the strategy that we're going to employ in FAR2. The next step then is for you to begin to review the notes and maybe watch the PowerPoint presentation from the publisher's website that outlines Chapter 13.